buenos días a todos. Sean bienvenidos al seminario Mercados y Desarrollo.
Good morning. Welcome to this seminar, Markets for Development, Improving Lives Through Competition.
Durante el seminario,
During this seminar, I wanted to remind you that you can send in your questions. How do you do that? By scanning the QR code that will soon be put on the screen. We have a video that is ready to show you right now.
Now we welcome to the stage Laura Alfaro Maical, Chief Economist and Economic Advisor of the IDB. Laura, bienvenida.
Welcome, Laura.
Everyone, it's a pleasure to welcome you to this important discussion on markets for development, improving lives through competition. Thank you for joining us in this beautiful city, in person and online. In Latin America and the Caribbean, competition is not just a market issue, it's a development constraint. It keeps productivity low, it limits growth, it slows innovation, it increases income inequality. That is why the Inter-American Development Bank placed competition at the center of this year's flagship publication, Development in the Americas Report, Markets for Development, Improving Lives Through Competition. We began by a simple fundamental question. How do we measure market power in the region? For too long, we lacked comparable data across countries. We didn't know with precision how concentrated markets were, how large markups are, or what are the implications for productivity, wages, and inequality. The gap led us to build Compete LAC, a platform that harmonizes indicators of market power across Latin America and the Caribbean. And once you have the data, you analyze the data, the message becomes very clear. If we strengthen competition through credible institutions, smarter regulation, and more open markets, GDP per capita could increase by 11% on average, while inequality could fall by 6%. These are not marginal implications. These are macro-relevant. These are development-changing implications. So our keynote today is Professor Jan Eekhout. ICREA Research Professor at University Pompeu Fabra and Professor at the Barcelona School of Economics. He served as the President of the European Economic Association in 2024, and he was awarded the prestigious Rey Jaime Primero Prize in Economics. And he is the author of the acclaimed book, The Profits Paradox. Professor Eekhout will lay out the broader case on the causes and implications of market power at a macro level, and then we will turn to a distinguished panel to move from diagnosis to implication. Jan, the floor is yours.
Thank you, everybody. everybody for being here. Laura talked about the profit paradox. The profit paradox is, I think, best explained by a personal experience I had. I met a friend of mine, Alex, a few years ago, and when we met and exchanged greetings, after a while he says, you know, I used to have a business in Silicon Valley, a startup, and I failed. I'm returning to Spain. He was Spanish. And when I asked him what had happened, he explained the details of what occurred to his startup business there in Silicon Valley. In the meantime, we were in a bar and there was news on the TV screens, and the news on the TV screens was saying that there was something, newsworthy, which was that the Dow Jones had reached 30,000. Today we're at nearly 50,000. The last few days it has gone down a little bit. But the news back then by the CNN anchor was that this is good news for the economy. This is good news for the economy because, well, businesses are profitable and businesses are doing well, and that's being translated in high stock market valuations. And as we explain and talk more about Alex's case, Alex says, no, not for me. I didn't see that in Silicon Valley. My experience, not only of my firm, was that it was much harder to be successful with a startup, but also I saw far fewer startups in Silicon Valley and in the rest of the United States in these technological environments where he had his business. And the waiter comes to us and says, for me the experience was very similar. I mean, I've been working as a waiter for 17 years and the wage I take home today is exactly the same wage that I took home 17 years ago when I started. And this is what I mean by the profit paradox. There's on the one hand very good news, successful stories of high profitability and high stock market valuations. And on the other hand, we see things going on in the economy that are very different, not so healthy, that are problematic for startup firms, for small businesses, that are problematic also in the labor market. And what I would like to do today is really engage in what this paradox is about. And I'm going to do two things. I'm going to give you a number of facts that tell us where this is all coming from, and then give an analysis of the causes and the consequences of this. So let's start with the first fact, and I talked about the Dow Jones. If I show you the Dow Jones starting after the Second World War in 1945, I'm going to show you a series here which is not the one you usually see because it's adjusted for inflation, and we know that for all long time series data we should adjust for inflation. What we see is that the Dow Jones from the 1940s was fairly flat until 1980 and then started to rise enormously from 1980 onwards. There is a before and after 1980, and you will see this repeatedly in the statistics and the data that I'm going to show today. Something similar to the Dow Jones is what I'm going to call the markup, and that's the difference between the price at which firms sell their goods and the cost. So it's the ratio of price to cost. So if a markup is 1.2 or 1.3, it says that the firm sells its good at 20 or 30% above what it costs them to produce it. And what we see to the markups is that since the 1950s, it's been again moving a little bit, but fairly flat. From 1980 onwards, markups have been rising massively. This is very similar, by the way, to what we saw for the Dow Jones. So these markups and these market valuations show a similar pattern, fairly stable until 1980, a sharp rise from 1980 onwards. This is not just a phenomenon for the United States or Latin America, this is global. I'm going to show you the same series of these markups for the world, and they have a very similar pattern worldwide, in Europe, in North America, including Canada and Mexico, in Asia, and in Latin America. And by the way, Laura mentioned the IDB DIA report, which is really doing much of that data work, which is very high quality research and data work that is being condensed in the DIA report that came out in September of last year. Now, what are the macroeconomic consequences of this? And I'm going to focus on three sets of consequences. One has to do with the labor market, the second has to do with what we call business dynamism, and the third has to do with inequality. So let me start with the labor market. There's a concept that we know as the labor share. And what is the labor share? It's basically as a share of GDP, what fraction is going to compensate for labor. The rest goes to compensating for capital and the remainder is profits. And what we see is that the labor share starting in the 70s has started to fall from around 2/3 to around 59%. And this is the first time we've seen this in history since we collect data, because until the 1970s and early 80s, the labor share was around 2/3, fairly constant. This tells us something about what's going on with wages, and I'm going to show you the next fact, which is relating productivity to wages. I'm showing you normalize the series of productivity, how it evolves over time, and at the same time how wages evolve. And here I'm going to show you the wage of production and service workers, which are about 85% of people in the labor market. It excludes managers. I'm going to show you managers later on. And what we see is that, again, since the 40s, productivity grows at a certain rate, and so do wages until 1980. And in 1980, these wages start to stagnate, and it becomes an increasing gap between what we know as the productivity and what we know as the wages. And this is telling us that something is going on, again, starting in 1980, that's driving a gap between what productivity is generated by labor and the compensation for labor, which is these wages. The second set of consequences have to do with what we call business dynamism. How dynamic are businesses? And we have a statistic for that, which is called job reallocation. And what is job reallocation? Job reallocation is the percentage of jobs that are basically each time new in a firm, and therefore as a whole in the economy, per year. So it's saying that how many people are hired, how many people are promoted, how many people are fired. And on average, that was around 35% in 1980. What has happened since 1980 is that this job reallocation rate has dropped to 25%. That tells us that the dynamism in the economy has declined a lot. It's declined really from 35% to 25%, and this has implications for how efficient business is, how good business adjusts to new situations, and this dynamism is linked to the fact that we have these firms that are doing very well in the economy, and I'm going to come back to that. A second impact that we can measure, and which measures something about, again, this business dynamism, is how many startups we have. The story I told you in the beginning of my friend Alex is not a story in isolation. This is a story that is actually more widespread for the entire economy. You would also see this in the IDB DIA report is being reported, that also in Latin America this is the case. The fraction of startups as a fraction of the total number of firms used to be around nearly 14%. That has fallen to around 8 or 9%. This is a massive decline. This is nearly half of what it was before. And why is this important? Because startup firms are the firms that hire most new workers, they hire most young workers, and these are the firms that innovate more. So if you have fewer startup firms, that also means that you basically have a decline in the dynamism and also in the innovation in the economy. The startups are the building blocks of the economy, and if we take a huge chunk of these building blocks away, the economy eventually is suffering. It also has implications that I mentioned earlier on inequality. Here I'm going to show you the evolution of wages for people with different years of schooling. I'm starting at the bottom in red, the people with high school degrees or less, people with 2 years of college, people with 4 years of college, and people with more than 4 years of college who have studied a master's or are doctors or are lawyers or have a PhD. And what we see is that from the 60s until the 80s, these four categories move in tandem, and from the 1980s onwards, this is spreading out. Okay, and we see that this is beneficial for those with more education, 4 years or more of college, but if you see at those with high school degrees, in fact, their wages have actually been declining compared to what they were in the 60s. And this is something you hear often people say, especially people who do jobs for those with less education, that the level of their wages is actually lower than what they saw their parents or their grandparents got for compensation. So this is telling us something about the inequality that we observe in the economy and the rising inequality, again, that starts in 1980. So now the question is, why 1980? And first of all, why at all is this happening? And I mentioned earlier that the profit paradox gives us a tension between, on the one hand, the benefits and profits that firms make, and on the other hand, these implications that we see in the economy. And I put here kind of an image of a big castle with water around it. And the reason why I put this image up is because there's an interesting story by Warren Buffett, arguably the most successful investor in history, who probably about 25 years ago gave a talk to MBA students in Miami, in Florida. And the MBA students ask him, they like to call him Warren. They say, Warren, what makes you decide to invest in one firm and not in another? What makes you pick which firms are interesting for you to make investments in? And he says, it's very simple. I want a firm that looks like a castle. I want the castle to be strong and solid, thick walls, that's not going to break down very easily. Second, I want it to be a duke or a duchess who's in charge of the castle, who's going to take care of the castle, who knows the castle, and is going to do everything to either maintain or improve the quality of the castle. But he said, third, the most important thing I want there to be is a big moat around it, a big moat with water. And I want this moat to be big because I want to keep out anyone to be able to get close to that castle. And he's thinking of competitors. I want there be no access for competitors to those markets. So if a firm is isolated with a moat around it, then it's basically going to be able to be profitable because it has a monopoly position. And he says, if the moat is not large, make it larger. So I want my duke or my duchess to make the moat larger. And if not, then they were in Florida, throw in some alligators and some crocodiles just to make sure that people stay out. And I think this is an image of Warren Buffett's that tells us clearly what happens to firms that manage to create a dominant position, that manage to create a position that, generates monopoly power. And I want to kind of think of where do these moats around these castles come from? And I think if we think about the causes, there's, different sources for that. One is that competition policy has not been always as active as it should have been. Second is technological change, and third is globalization. And if I think of technological change, which is the main driver of the creation of these dominant firms, and by the way, these dominant firms, there's only a few of them in the whole world. There's about, in our data, maybe 300 or 400 maximum worldwide. Now these firms, out of probably 100 million firms in the whole world, these 300 or 400 firms, of course, are very impactful in the economy because they have, large markets. They are large. So even if 300 large firms, that is few firms as a share of the total number of firms, they're going to have an impact just because of their sheer size. Why? Because they're active globally. Their market is the whole world. They're not very local in their activities. But with technological change, if we think about technological change, what technological change really does is, in the movie of the economy, it's both the hero and the villain. And what do I mean by that? Well, it's the hero because technological change creates progress. And if I think about all the things we do with our technology today, from curing cancer to helping us run businesses much more efficiently than we could even 15 or 20 years ago, this is something that we really need to pursue. This is something that, as an economy, whether it's in Paraguay, in Latin America, or around the world, which is something that we really want. But at the same time, the technological change, and I'm now talking about the digital technological change, this also causes harm to the economy. That's why I say the hero and the villain. Why does it cause harm? Because the digital technology is a technology that allows us to create scale that creates network externalities, as we call them, which means basically that we have firms that can use networks that are better large than small. And all of this is a source of having, well, just one monopoly firm in a given market. And if I think about the tech firms, they are precisely those firms that are exploiting these scale advantages to the maximum. And this is particularly the case with the digital technology, because the digital technology is a technology that is built for scale. Enormous setup costs, enormous cost of investment, and at the same time, very small cost to operate. If I think of an Uber, for example, the cost of Uber is to build the technology in the platform, to create a user base, both for the drivers and for the customers. But then once you have that base, you're the dominant firm in the market, and you basically create a monopoly position like that. And 1980 is a particular crucial year, and as you've seen, we see things change in the data in 1980. And the reason why 1980 is the year that's so crucial is because that is the year where digital technology starts to enter into the economy. Households start to buy computers and use them. Firms are using computers, they're using servers. So we start to see a digitalization of the economy in 1980. And that's precisely the reason why in the statistics that I showed you earlier, we see that change happening precisely in 1980. Now, what is it we can do about this? Is there any policy that can help us to address this? And people often talk about taxes as a way to do something about these outlandish profits that firms like Meta or Google make, and if there's a way with taxes that we can address this. And we can do something with taxes, but really the problem with taxes is that it doesn't address the problem at heart, at its root cause. Taxes really don't create more competition. What we need is create more competition in a way that allows there to be kind of a challenge, a contest to these monopoly firms. And there is a concept which is called interoperability, and interoperability is the idea that if I have at the same time this technology that it requires scale, I'm going to exploit the scale, which is beneficial, but at the same time, I'm going to allow for competitors on that scale. And we see this in recent years in different countries. High-speed rail lines are, well, one scale-advantaged railway system, the rails themselves, but at the same time, the interoperability regulation allows for competitors to compete on these rail lines. We see this in telecommunications. Telecom firms in some countries have basically kind of interoperability rules that allow competition on these networks of, for example, the cell tower systems. And this is a way in which you still exploit the scale of the advantage of the technology, but at the same time you allow for competition, and competition is something that really allows you to get the most benefit out of these technologies that you're building. And with digital firms in particular, we want to treat these digital firms as utilities the way telecom firms were treated in the 90s as utilities, which means that they are going to be regulated to get this interoperability, the way transportation firms have been regulated to get interoperability, and the way, you know, the utilities like electricity and water, which are by a long time we've known that these are monopolies, and we have ways in which we can make this more efficient. This is something that's particularly relevant for Latin America, and I think that the Inter-American Development Bank has an important role, not only with the report, the DR report that they published in September of last year, but also I think at the policy level, a coordination across different Latin American countries is going to be beneficial in enforcing competition in the different countries. Why? Because many of the companies that are active and that have the dominant positions are currently companies that are active across borders. And coordination across the Latin American region is going to be very important to obtain this competition. This is already telling us that this is a global problem. If it's a global problem, we need a global solution. And so when we think about this, sometimes people say, oh, we need to be like Silicon Valley where all these dominant firms are. Well, but then Silicon Valley, if you're going to some parts of California, there's no dominant firms here. What we really want to know is where the customer is. And the customer is everywhere. And that means that we need a global solution. And I think that the Inter-American Development Bank plays a role in that, as I said. So we need more global institutions, not less. There's one issue that we, of course, have to worry about in this context is that there's a vicious circle in the politics of it. If firms have market power, they create profits, and profits allows them to lobby for better regulation, which in turn creates more market power. And this vicious circle is very hard to break, and I think international institutions, again, have a role to do that. Let me finish with just asking the question, how bad is it and how much worse can it get? First of all, how bad it is, it's at least 8% of GDP. That is the cost that we estimate of having more market power today than we had in 1980. If you look at a firm like AWS, Amazon Web Services, compared to Amazon, AWS is 16% of the sales of Amazon, yet it is 74% of the profits. What is this telling us? This is telling us that basically, if you look at a firm like Amazon, the data kind of networks that they're creating, the data services that they're offering are an example of even more dominance of these firms, the more dominant positions that they obtain. And that basically tells us that with the advent of artificial intelligence, with the advent of data centers that are growing more and more important, this issue of dominant firms is becoming more and more important also with time. So I think that as customers, whether we are in Paraguay, whether we're in Latin America, or customers of the world, we have no option to start to think to do something about it. Thank you very much.
Thank you, Jan. Thank you very much. We invite you to take a seat, and joining Jan on the panel are Troy Waterman, Executive Director of the CARICOM Competition Commission. Welcome, Troy. Thanks for being with us. Also, Javier Bernardes, CEO of Grupo JBB and former President of the Club de Ejecutivos del Paraguay. And Esteban Greco, Director of Games Economics. Also, our moderator, Laura Alfaro Maical. Welcome again, Laura. Welcome, everyone.
Thank you, Jan, for that very insightful keynote. You made central that competition affects everything: productivity, wages, innovations, long-term growth. More competition can raise growth, but realizing the benefits of competition requires more than data, more than facts. We need to implement it, and that is the focus of our discussion. Thank you also for reminding us the importance of the 80s. I have always told my daughter it's an important decade for music. I'm gonna quiz the audience to find out what is your favorite 80s song. This was the moment where we started to see a lot of those changes in technology that have marked our day-to-day life today. So that the audience knows, 1980, one of the best songs was Another Brick in the Wall, Pink Floyd, Rock Your World, Michael Jackson. And so I'm gonna quiz you to see if you're paying attention to this very important topic. Also, let me remind you that in addition of sending your favorite 80 songs, you can also send us questions through the QRR bar that you have, and we're going to have a Q&A session at the end. So please do share your thoughts in terms of competition and questions for our panel. So let me start with you, Esteban. I'll ask you about your 80 songs later, But first, you have had an important role as director of the Argentina's Commission for Competition. So from your experience, what are the key institutional constraints that limit the effectiveness of competition policy, but also more positively, what are the tools you have seen that actually do allow more firm growth? And perhaps you can share some more concrete examples.
Bueno, gracias, Laura. Thank you very much, Laura, and thank you for having me here so we can discuss these issues. I think we have about an hour. Is that right for my answer? But just to sum up, I think that there are a number of constraints, and I'll share a little bit of what my experience has been in Argentina and Latin America. It starts with the cultural, in other words, how business is done, what engagement looks like in the market. Sometimes it's not well understood what the rules are, and agreeing with competitors to set prices is actually illegal and can be damaging. So that's one issue. And then the other constraint, and this is more of a general constraint, has to do with how important the competition policies are and how it plays with the public policy aspect of the country. And so one thing that I've always appreciated is the idea of the three Ps, is what we call them in Spanish, the three types of instruments. One is to penalize, to prevent, and promote. So you penalize anti-competitive practices, you're penalizing cartels and anything that is antitrust. That's one of the biggest issues in competition. Also preventing concentration, when concentration could lead to anti-competitive impact, and this is why you have mechanisms to oversee, ensure that there is no monopoly and that there is no concentration of businesses. And that's better for merit and for competition. And then lastly, competition advocacy on the promotion side. I think there are two dimensions here. And that's how, as you try to promote competition. One is that it is part of public policy. That's what is being promoted. But additionally, there's also the enforcement of legislation. So there's that tension between supporting as part of public policy what competition is, but additionally also giving enough independence so that decisions on penalties and looking at cases of concentration to ensure that that is conducted independently. And so there's that independence that needs to be ensured for the different agencies that look at competition. That's important. And just to give you an example, bring this down to a practical level, I was part of the DIA chapter, and it focused on the implementation part of what agencies do, and that's in the book that I encourage you all to read. And it's had a big impact. This was a case in Argentina, but something that we have seen happen in similar ways in different countries. This was a market study looking at payments. There were 14 of the biggest banks in the country that were all partnering as part of one firm. And as part of that partnership, for a very long time, there was a de facto monopoly in how businesses could access payments with credit cards and debit cards. And there was work that was done there with a market research that was done by the agency. And based on that research, the market was able to find what the constraints were. And there was an investigation that was launched for a violation of the law, but at the same time, there was work that was being done in coordination with the financial regulator, that was the central bank, in order to get rid of some of the regulatory barriers that were keeping other players from coming in. And so what we saw was that there was progress on both ends. There were pro-competition regulations to bring down barriers, but additionally there was a case that the agency was able to make headway on, and that led to a divestment. It broke up that configuration, that closed group, and when you look at the results, it was a pretty big impact. Digital payments were lagging pretty far behind in Argentina, and after that we can actually see how that moment changed things. We started to see new services, and we even saw an impact on financial inclusion indicators. From 2017 to 2024, financial inclusion increased significantly. The indicators, the international indicators in Argentina showed great progress. 49% in 2017 is what we saw for individuals who had a bank account or a payment account or access to the banking system. And that was above 82% in 2024, which was huge. These kinds of examples, these kinds of cases are really big, both in Argentina, but also Chile, Mexico, and Brazil. And in Paraguay, here as well, there's been a pretty big case with implications for increasing competition for sectors.
This example highlights one of the themes of this seminar, that competition not only has productivity effects, it has inequality inclusion benefits as well. And also thank you for your chapter. This, as I have said, this flagship report, it not only brings data, theory, empirics, but also has great chapters that bring practice and the evidence on the ground from the region. Let me now move to Troy. Troy, as Executive Director of CARICOM, you oversee regional competition across multiple islands that also are very integrated. What are the challenges in these type of scenarios where the markets are relatively small, but they operate across countries? And let me just emphasize that that is a reality in the Caribbean, but it's a reality across the region, Central America, even South America. Most of the markets are relatively small, and we do have interactions across countries, but I do think the Caribbean has special insights on this topic.
Yeah. Well, first of all, I'd like to thank the IDB for the invitation, and the IDB and Paraguay for being such exceptional hosts. Laura, thank you for the question. Now, it's best to approach a response really in terms of establishing a contextual framework really with regards to businesses and trade in the Caribbean. And what we see typically is that there are not a lot of businesses per se. You have these pockets of larger companies that were established generations ago that have grown big. So you'll find then that in many instances they've diversified quite successfully as well in terms of across practically all sectors and some of the critical sectors in terms of economic activity. So for example, manufacturing, services, finance, and even in terms of shipping and retail distribution. So you'll see some linkages there that create a number of issues really from a competition perspective. And certainly in terms of establishing policy as well. The policy prescriptions then become a little bit nuanced. In many instances, they might not necessarily fit the purpose, and it goes back to the dynamism that Jan spoke about. So in essence, then you find that there's a lot of vertical integration of these companies. Now, vertical integration, subsidiaries or business units then operating in different territories or different islands. So it becomes then in terms of when you look at it from a helicopter view, you find that you have companies, you have businesses, but then you have the big ones and then you have the tiny ones. The big ones typically establish a strong foothold in the economy. The smaller ones then echo an existence. And even within that dynamic, you find that there are different motivations, there are different drivers then that would dictate how and when businesses, one, conduct businesses, and then how they conduct businesses as well. So what is another interesting phenomenon that we've seen is that even within these businesses, we at the level of the policymakers, at the level of the regulators, will realize that there are some issues really with regards to how these businesses operate, especially the big ones. And from an outsider looking in, you will think that there are a number of companies, but then when you dig a little further, it's starting to find out that they're actually they share the same owner. So as a result, then it's not necessarily competition as we would see it typically. It is just you have different ways and means of of doing business, right? So what is interesting too in terms of these conglomerates, these homegrown conglomerates that we would call them, is that you find that there's a period of contraction and expansion. Right now, we are actually in a period of contraction. So a lot of the companies are divesting certain business units, and we anticipate that there's something else going to happen really with regards to another sector soon. It's time now, and that's in financial services. So the CCC, the CARICOM Competition Commission's role as established by the Revised Treaty of Chaguaramas, is to look at the cross-border effects. Now, sounds all well and good, might be simple, but then there's some complexities associated with that, and those complexities are associated really with regards to the fact that we are dealing with 15 member states in CARICOM, 15 completely different member states in some instances with regards to their geographical location. They're dispersed. You have distinct markets by virtue of the fact that they are in separate islands. So it's not necessarily a case where, yes, we are an economic bloc, but then there's an economic bloc that comprises very independent, very individual countries with their own nuances, with their own idiosyncrasies. And the task then with regards to these different distinct economies is you have different diverse drivers for growth. So which means then that the policy prescriptions are going to be very difficult to manage really at the level of the CCC and certainly in terms of organizing how competition should occur, right? Now, sociopolitical, socioeconomic, geocultural differences. Drop a few businesses in that mix, and then you have a really interesting outcome. So our mission then really is to look at and assess and enforce competition law and policy at the level of the cross-border dimension. So we're not necessarily a case where you look at what happens in country, but really in terms of what happens in country and its effects on other member states, right? Now, it is a case now where if the CCC, when we're looking at trade, extra-regional trade, when we're looking at the impacts of business conduct in terms of competition, there's a challenge there. And one of the challenges, well, there are a number of challenges, but one of the major challenges then is in terms of how the regime is supposed to work really in terms of establishing what the markets are, establishing what the barriers are to competition, establishing who the players are. But then we have in that mix then the conglomerates. How do we deal with them? Certainly in terms of how do we deal with the parent, in terms of you have these separate, independent, in terms of functionally independent operating units operating in the individual member states. And then the task then at the end of the day is for us to coalesce these different markets into a single economic construct then that we can call a regional market, and then how do we then adjudicate really with regards to competition impacts. It's a difficult task to even pursue, to contemplate even, to conceptualize as well. So how does the CCC then account for the parent in those instances, because we recognize too that the parent might not necessarily be operating in the particular market itself, only by virtue of the subsidiaries, which, as I said, are themselves independent, right? So do we account for the parent as well? There's still a question that really relies on the case in point. So in some instances, we've seen where you would have to implicate or investigate the parent. In some instances, we may have to make that decision as to just focus on the subsidiaries. Now, back to the main point really in terms of extra-regional trade now and the impact, you'll see then that you have the parent, we have to assess then at the level, even before you get to the extra-regional point, we have to look at the intra-regional market as well. We have to look at the country level. So it goes really in several directions. You look at the company, you look at the country, then you look at the impacts within the country, we look at the impacts across countries, and then there's another phenomenon whereby we talk about CARICOM, and then we talk about the sub-region really with regards to OECS, the Organization of Eastern Caribbean States, which is also a subgrouping of CARICOM. So then we have to look at it within that sub-regional block in terms of the effects, and then within the broader mix then of CARICOM. It's quite difficult. And so at that level then it becomes a point of just organizing, right? So access to markets, then when we talk about the investigation of anti-competitive conduct, then it has its implications really with regards to how we define the market. It has implications really with regards to how we assess the impacts as well. So we assess the impacts at the individual level, at the country level, at the intra-regional level, at the extra-regional level as well, because we haven't factored in imports coming into the region and then and external players and how they impact and influence the market as well. So there are a lot of overlapping disruptions really when we have to look at the broader scheme of things too with regards to industry. We're talking about regulation as well, how regulation is formulated, how it's structured, how it's implemented. Sometimes at cross purposes, so it creates a tension there as well. Civil society, governance, even national security. Those are a number of issues then that we have to contemplate. So there are a number of overarching themes then with respect to the distortionary effects of competition on market composition, market conduct, the drivers for competition, in all competitiveness. And just for fear of oversimplifying it, we talk about the art and the spirit of competition, which encapsulates then all these elements as well of competition, composition, conduct, and the like. So there are a number of themes then that emerge when we, from the perspective of a regional enforcement authority then in terms of assessing cross-border conduct. So you have the internal and external pressures to support, in many instances, marginalized sectors, and you can't ignore that. So how do we integrate that into the mix really when we talk about adjudication with regards to competition?
I'll follow up to get more details. But let me try to bring the experience also of the private sector so that we start getting these different perspectives. And as you mentioned, it's very complicated because our realities are complicated. A lot of these restrictions do mean that firms have to find a way, and many times it's through vertical integration that not only allows you to deal with sometimes supply risks, but also allow you to have some financial backing for different activities. So a lot of our institutional constraints in financial development and also start affecting how we implement competition policy and may also affect, as you mentioned, autonomy, given our realities. But please also remember to keep sending questions through the QR code. But let me go to Javier. Javier is CEO of the group JBB and former president of the Club of Ejecutivos of Paraguay. He brings the perspective of a business leader who has operated across different sectors in this fast growing economy. I have to say that I was here in Asunción, I think in 2010, and I am shocked of the transformation of this economy in these years. And so you can share a little bit your view. So in your perspective, what are the regulations that make it hard for new firms to enter? But perhaps also you can share if you have examples of policies that were well-intentioned but ended up backfiring in terms of the implications to encourage competition.
Y este no me puede ser.
No sound coming in.
Aumentando año tras año. Tenemos un
We have low inflation. We have considerable reserves at the central bank. and we have debt under control. Having been able to get investment grade from two CRAs is no coincidence. That is the fruit of direct work on regulations and standards and decisions made by different administrations. There has been an effort to keep ramping up that work and keep the momentum going. However, in order to sustain those policies that we've been working on and keep up with the fast growth in Paraguay, we need competition. There is no economy in the world that can grow or move to the next stage without competition. Competition, as my fellow panelists have said, leads to better prices for consumers, leads to more job security, better wages for employees, and better quality of products. And so without competition, there is simply no way to think about markets growing. In my experience, the roadblocks haven't been the laws or the passing of new laws. Sometimes we actually see that there's a saturation of laws and regulations. There are some regulations that try to give order to the framework, but at least in our country actually keep development from happening or keep new companies from coming online. A set limit on the number of operators or licenses, for example. If the government isn't consistently evaluating demand, then it's hard to keep those larger companies under control. Really, the markets are a living thing, and so we're looking at the situation that we're looking at in Paraguay. I mean, like we're not just sitting on the tarmac; we're actually taking off. And we are the country that has had the fastest and highest growth in economic stability in the region. We have a pretty calm environment in Paraguay. We don't really have to deal with some of the weather events. We don't have any issues with earthquakes or other natural disasters. It's an attractive destination, so we need to try to increase the number of players to improve competition. Now, beyond all the great things happening in Paraguay, I do have to go back to your question, and there are some things, some regulations that make it more difficult for new companies to come in. And I do have to mention that there are a number of situations that the country is working on, but there's still a need for more investment. Ironically, we produce 100% of renewable energy per capita. We have 3 hydroelectric power plants. We have a lot of available power, and we're able to generate a lot of power. The problem that we have is transmission, as well as distribution and actually selling that power. When you have already installed industries, you have businesses that were under ANDE, the national power utility, there was availability of energy, and so those companies were able to get energy directly from the agency. But now for a new company to come into the market, they had to invest to get substations, transmission lines, or try to plug the hole created by the lack of funding in investment. And so that is a barrier to entry, which is a very real situation in Paraguay. Paraguay needs energy and to allow for new companies. It needs energy to grow the current the incumbents, and also we need stable power, no power outages. Right now we see that all companies have electric panels, have computers. The entire industry runs on energy. If we can't get that energy fed in a stable way, it's very difficult for new operators to join us. I know that it, it's not easy to look at the number of years and how much is necessary. This is not something that you can do from one year to the next. You have to think about investment and what the needs are. So we're in a situation where we need investment for the power utility, and that's why we turn to the IDB and say, hey, can we get some money with low interest, long maturities, so that we can invest more in the power utility. And we do have history with the IDB. In the 60s, this is 6 decades ago, the IDB was the top investor for developing and building the first hydroelectric power plant in Paraguay. That was established thanks to studies and funds from the IDB. Then a few years later, the IDB believed in Paraguay once again, in Paraguay's energy, and provided hundreds of millions of dollars to improve those plants. Then Interpool came later down the line, and then we have Brazilian and Argentinian partners who also joined us. And so we do have history with the IDB that goes beyond what we are talking about today with energy.
Let me advance a little bit. Because you mentioned another key issue in competition. We tend to think about regulation, autonomy, size of markets, the complication of the size of markets, integration, but there's another one, the basic infrastructure, maybe limiting firms' entry and growth. I want to get a new round of questions to the different panelists, so perhaps now we can go, given the time constraints, a little bit shorter. And I want to go back to Troy, because Javier, you mentioned the complication of being able to estimate demand and growth. This is key to be able to assess, do we have enough licenses? Do we have the new information? But Troy, you had already mentioned the challenge of doing this when you have 15 states with different realities, different geographies. And so how do you then coordinate national enforcement and regional markets? And do you have examples where this has worked? Again, the reality is that most of the countries in the region, we need each other. In the IDB, we are 100% behind regional integration as a way to achieve scale, productivity, and growth. But that does have challenges. We have to regulate and coordinate different markets with different realities, and I think you have the scars to tell us how to do that.
Well, it becomes problematic because you have, regional integration will rely on the establishment, if it is effective, of a regional competition regime. It also relies on a regional cooperation regime as well, right? So, but here's the challenge. We are operating in a vacuum, a regulatory vacuum, because of the 15 member states, only 4 of them have a competition regime. And those are the individual competition regimes. So Barbados, Jamaica, Trinidad and Tobago, Guyana, all at different levels really with regards to how they operate and how they're effective. Now, the effectiveness of the CCC then relies on two philosophical approaches really with regards to effectiveness. One of which is you have the whole doctrine of supranationalism versus intergovernmentalism as well. Supranationalism would require then that member states would cede some sovereignty or authority to the CCC really in terms of coming in and adjudicating. But that doesn't happen. We have actually had to rely on intergovernmentalism really with regards to working closely with the national authorities really to be effective. But then it blurs the lines really in terms of the regional authority and the national authority if you also have to coordinate. So it means then that additional elements will have to come into play really with regards to the effectiveness of either regime. Now, add to that the challenge of harmonization of legislation as well. So you do have competition authorities that I spoke about, but we still need to be able to harmonize the regulations, the policies that drive them. And then how does CCC then fit really with regards to that? So there's still a lot of communication that needs to go on, even in terms of the policy making and policy prescriptions that I spoke about. Sometimes they work at cross purposes. So it means, although they're well-intentioned, there are some elements really that can lead to self-sabotage in terms of the policies not necessarily being fit for purpose from a broader perspective. Let's give the example of trade remedies. We know the purpose of it in terms of dumping and unfair business practices, but then in terms of the policy prescriptions that are developed might be actually in conflict and create a tension really with the competition regime and the purposes of the competition regime. So it means then that there still needs to be a lot of dialogue between the different agencies, the ministries of finance, the ministries of business, and the like, really in terms of making sure that policy prescriptions are neutral, competitively neutral, and then allowing the CCC and the national and the competition authorities as well to come in and do the necessary assessments. But this can only be done if there's information. And typically you have issues really with regards to access of information, access to usable information, and then the availability of such. So in many instances then you have the repositories, but the repositories are holding that information. And in some instances you can understand why, especially in an era now of data protection and what have you. So it means then that there still needs to be that level of communication really where you give that comfort in terms of how the information is going to be used, what is required, and how it is then at the end of the day going to facilitate more competitiveness really in the market. So perhaps it's an indictment on the competition authorities really in terms of not necessarily demystifying competition, if you will. And so work still needs to be done really where that's concerned. And I think it allows us then for that dialogue again, that continuous dialogue to occur.
Thanks. So we have, can you hear me? As a key variable, this dialogue, this communication, but also you mentioned information, and perhaps being able to adapt to the realities of the policies implemented. Esteban, some of you, if you can share some of your views on how we can strengthen competition policy in the region.
Okay. Sí, creo que ahí, digamos, la situación puede ser diversa. Las agencias encargadas de proteger la competencia.
There are different situations. There are different types of competition in the region, and historically there have been different phases. A lot of them go back to 2000, 2010. The most recent one was in 2024, and that was in Guatemala. So for institutions are young, and working with the IDB, we have also drawn comparisons, looking at the competition agencies in Latin America and comparing that to the OECD. And one of the strengths required is greater priority of competition policies, and that can be reflected in increasing the budget for these agencies. They're well below what exists in the OECD, and you need highly qualified people to perform this type of task. Also, and there's that tension between giving predictability to policies, making policies strong, but you need these agencies to be independent so they can make decisions, for example, to approve sanctions if something is anti-competitive. But also there has to be coordination amongst governments, something we have seen that many regulations, rules and regulations can create a barrier to competition. I gave you an example about the financial sector, and that was a good case. And that also ties in with what Jan was saying about interoperability and the infrastructure that could promote competition, because that's interoperability that makes it possible to get more players to come in and cause more services to thrive. Now, the case of Latin America may be different from what exists in other countries. And there I'm referring to how the digital economy is going to play out. I don't think that we necessarily have to pass regulatory laws against regulatory power because we have experience in the region. For example, we were talking about the fintech. A lot of startups, a lot of fintechs, regional fintechs have emerged and they have been able to challenge a lot of incumbents in the market. We have a lot of incumbents that go way back. So it's not good for us to send a signal that would discourage innovation or entrepreneurship in the digital sector. But now, regarding the potential of competition policy, there's a lot to be done in coordination and also by analyzing the impact of different regulations. So, when we pass a regulation, we don't want it to work against competition. We need to find a formula that doesn't damage competition and strengthen, especially in terms of our ability to penalize cartels. That is something that is an impediment to progress in the region. Then also we have some programs of clemency, for example. That is something that Uruguay doesn't have, and it was regulated just recently. But I think that these are important tools that we need to strengthen.
Very qualified folks working in these agencies because it's not easy. What may work in one country may not necessarily work in another, and you mentioned the cases of tech and fintech in the region. Javier, from the point of view of the private sector, what can the region do to improve competition policy?
Primero,
Well, first, investors are very keen on there being clear rules, much more so than tax advantages. So that has to do with the investor, but also it is important for the state. We need to have rules in place. Now, this is something the Comacom, which is the National Competition Agency, and Comacom has to be strengthened. Just like many other institutions in Latin America, they need to be strengthened. And when I talk about competition, Comacom is in need of greater budget. It has to be given its own identity. It has to be unleashed so it can take action. And in that way, the private sector will have clear rules, a clear playing field, so they can operate better. You gave me a very short period of time. The thing is, I'm not cutting you off, but we are running out of time. So I did want to say that since I'm talking about Paraguay, what can we do in Paraguay? First of all, I want to tell you that Paraguay has some unique advantages. We have 100% renewable energy. We have a 10% tax rate both on VAT and on income. And we also have a demographic dividend. And we have stability, speaking in general terms. So we have stability, and in Mercosur, we can reach 300 million inhabitants. We do need to protect Comacom by law, and we also need impact instruments ex ante. In some cases, that will be helpful. The idea is to keep laws or decrees or municipal regulations. We need to make sure that they're all moving in the same direction. That's good for the private sector. Often you find that the law says one thing and then they try to implement something else, and municipalities are working in another direction. So we need a single regulation. Now, we have something called the companies of simplified form, AS. And in those companies, a foreign investor or a Paraguayan investor, they can set that up in 24 hours. Now, that is a great rule and regulation, but it clashes with other rules and regulations. For example, when they go to open an account at the bank, banks have very demanding requirements. That is part of CEPRELAC, which is the Secretary for Preventing Money Laundering. So we have to align our operations with those of the rest of the world. So that means that opening a business is quick, but it takes a long time to open a banking account. So we have to work on that. We have to lobby. We need to get the public and the private sector to work together to avoid these contradictions, these conflicting rules. For example, sometimes you need to show you have been working for 6 months before you can open an account. Now, how are you going to work without an account? And also, seniority is often an element of exclusion. How can you open a new business if you never worked with the state? So there are conditions that stand in the way of opening up this market so that new companies can come in and compete with incumbents, and in that way we can further develop.
To have dialogue and coordination across countries, across regions, across institutions, across municipalities and states, because these differences in regulation also can be the reason why we don't see more firms. And it could be well-intentioned regulation, but someone has to see the big picture, and that usually doesn't happen unless we're discussing, dialoguing, and communicating. So let me go to the Q&A. Because of the god of time, we may not have a lot of time, but I do have a question that came for Jan, related to the discussion we have been having on big tech, large tech firms. In a world dominated by large tech and multinational firms, is more concentration inevitable? Or can small economies and firms realistically keep markets competitive?
I mean,
in 2 minutes.
In 2 minutes, as we've seen from the discussion, issues of competition and concentration are everywhere. It's very multifaceted. I like very much what Javier said, is that if you invest, you want to be in front of an environment that's predictable, that you know what's going to come, that has clear rules of the game. And rules of the game may be actually having less regulation, as Esteban was saying, because sometimes less regulation is actually better, because they make the rules clearer. I think it's inevitable that with the digital technology, we need to change the way we deal with this new technology, because the new technology is introducing different ways in which firms can build their dominant positions. But I think one thing we've learned going back to Europe is that this coordination at the European level has been very beneficial in terms of implementing successful, efficient competition policy. And part of the reason is because the problem is going across borders, and you have all the examples in the Caribbean that we have these small economies where we need this coordination and communication. But part is also because it's, I believe, easier and clearer to set the clear rules of the game. Because the rules of the game, whether it's with more or less regulation, have to be transcending borders, because the borders are now also for the companies no longer existent. I mean, if you look at an Amazon, it's just the borders, they're not relevant for them anymore. And I think if the companies are transcending borders, I think that the competition authorities have to do the same thing. And I think very often, and I cannot agree more with Esteban, it has to be sometimes with less regulation, but clear rules of the game. I always say that competition policy is like, football, soccer. If you have clear rules, with an independent referee, you can have a lot of competition. And you see a beautiful game, o Jogo Bonito in Brazil, you get it because there is clear competition. But you need clear rules. You cannot have, your friend is the referee, or you cannot play 12 against 10. It has to be, clear rules of the game. And I think that's an important aspect, which with digital technology is now transcending the borders. And I think as competition policy providers, and I think the IDB can and should play an important role in this in Latin America, together with the World Bank worldwide, we have to kind of recognize that this is now a global issue that we have to tackle with global tools.
Thank you very much. So these recurrent topics, clear rules, dialogue, coordination, autonomy, these are important topics to be able to implement this very complicated policy. But a very quick question, favorite 80s song? The people want it. Favorite 80s song? La canción preferida de los 80s. Una, rápido. 30 seconds.
Another brick in the wall.
Soy muy joven para eso.
Same as,
Troy,
same as
you're too young for the 80s?
For me, it's Sultans of Swing, Dire Straits.
Oh, very good. Anything Michael Jackson. Anything Michael Jackson. So with that, as you have seen, these are very complex topics. This is why the Inter-American Development Bank has put competition as a central priority. Through development in the Americas, the Compete LAC and the DIA 2024, we want to bring these complex topics to you. I do recommend pick up the book. Guarantee you it's a page turner. You won't be able to put it down. Thank you very much for all the panelists. The goal is clear. Markets that are open, dynamic, and inclusive bring benefits to all of the region. Thanks.
Thank you to all of the panelists. Thanks to Laura for those wonderful interventions. Don't forget to share the event with the hashtags Reuniones Grupo BID y IDB Group Meetings. En breve continuamos con Más allá de la abstracción, cadenas de valor para minerales críticos. Thank you everyone. We will see you soon.
Join us in Paraguay on March 11 to 14 for our most important gathering, the IDB Group's annual meeting. Last year was the IDB Group's record year, with the highest ever level of $35 billion in financing, while strengthening the quality of our projects and processes, and therefore delivering impact. This led us to a year of record recognition, including Multilateral Development Bank of the Year. Now, we need to build on that. The IDB Group will focus on growth, has foundation for development, including